Welcome to Crypto in America Live, the only show bringing you candid conversations on the biggest news stories, legal issues, and policy developments shaping the crypto world, every Friday at 12 p.m. Eastern. Gerald, it's me and you again today.
Yeah,
How's it
good
going?
afternoon. Yeah, I'm good. We're back in the old stomping grounds. We're not on the road for once. And Jacqueline is stomping around in Patagonia, so we miss her again
Yes,
this week. Yeah.
she is. Yeah, she'll be back next week, hopefully, where she'll be when better Wi-Fi service in Argentina, I think, for DevCon. So she should be back next Friday. But we miss her. But for now, it's me and you. But we have a stacked show for you all today. We'll be kicking things off with Coinbase's Chief Legal Officer, Paul Grewal, who's here to discuss the exchange's move from Delaware to Texas. We've got Steve McClurg, CEO of Canary Capital, to discuss the big debut of Wall Street's first 33 Act XRP spot ETF. And we'll round out the digital chamber with We'll round out the show with Digital Chamber CEO Cody Carbone, who will give us his hot takes on the Senate Ag's market structure discussion draft and what the industry is saying about it. But first, as always, let's take a quick look at the headlines. Let's start off with SEC Chair Paul Atkins. He really made waves this week, Gerald, with his speech at the Philly Fed FinTech Conference, which I think you were at, and I think a lot of the industry was at. I honestly, when I wrote the newsletter on Monday and I saw that Fed Governor Waller was going to be there, I didn't think it was going to be such a hot crypto event, but it turned out to be, right? There was a lot of crypto people there.
Yeah, it's this continuation. The suits are here. We're all just combining forces and showing up in all the same places. I was joking, so there was Cantor in Miami on Monday. There was Philly Fed, and now we have the Thai doing Bridge in New York. So I think that route is getting a lot of traffic this week. But yeah, the event itself, I think, focused a lot on institutional adoption. Obviously, Chair Atkins being there, giving another like very bullish speech for the industry was really interesting to see.
Yeah, I know. So he announced a token taxonomy, which I think gave the industry a glimpse into how the SEC is thinking about classifying tokens. And I don't think there were too many surprises, but it seemed to align essentially with what the messaging from the SEC and the crypto task force has been putting out since Atkins took office. Some things that stood out to me were he's being very flexible around the Howey test in a way that Gary Gensler was absolutely not flexible, saying investment contracts can expire and network tokens, are not securities, and mainly that, network tokens and blockchains can mature and issuers can step back from their roles and promises. Paul actually pointed this out, and I'm sure we'll talk to him about this in a few minutes, that promises aren't kept forever, right? They have an
Yeah.
expiry date. And I thought that was interesting.
Yeah, and it was interesting too. I think I give credit to Goon from Avalanche as testifying in front of Congress, I think in 2023, about a token taxonomy proposal. We actually talked to him when we interviewed him at the summit about this. And then, of course, Miles Jennings and the Andreessen team have come out with another sort of token taxonomy framework. And so it's interesting to see, basically under the Gensler regime, it was like, if you provide a benefit to a token holder, Howey test. And
Mhm.
so I think classifying things is okay. These are tools, tickets, memberships, right? Collectibles. These are not securities. These are not investment contracts. And so it's good to see this language that really just provides definitions we can work with, right? One of the great quotes of the Philly Fed thing was financial institutions can't innovate in a gray area, right? So if you have everything as a gray area, nobody wants to do anything because there's just a lack of certainty. So I think seeing this framework like come out, and hopefully he also mentioned, of course, the importance of this getting into legislation, which we'll talk about later,
Mhm.
so that we're not relying on rulemaking. But yeah, good to see the progress and the alignment there.
Yeah, for sure. Well, another development this week was the Treasury Department coming out with guidance or safe harbor with the IRS for crypto ETF trusts to stake assets without jeopardizing their grantor trust status. And now I always go to Greg Exathalis when I want to get a lesson in the nuances of crypto ETFs, because he really is the guru.
Yeah.
But basically, my takeaway on all this stuff was that, the safe harbor was basically designed to open the door to allocators who might otherwise avoid all of this stuff, for like the tax risk, right? This kind of alleviates the worry that there's tax risk, and there's now sort of a framework around staking for digital assets in ETPs, which will open up a lot more institutional interest, is my understanding of it.
Yeah, and so this is kind of staking tax treatment is one of the last frontiers that nobody is talking enough about on the Hill. I don't think it made it into the big beautiful bill. It didn't make it into um, the Clarity Act, and I don't know if it's going to make it into market structure. So really, we are just kind of relying on IRS guidance from here on out until we can get it in some kind of a reconciliation bill or somewhere else. The challenge with staking is that right now it's taxed on creation. Um, not on disposition. So, if I have a farm, my chicken lays eggs, I'm taxed on the egg, not when I take it to market, but right when it's like in my hand, right? And so that creates a lot of problems for staking. If we are going to get effective ETPs and ETFs that use staking, which I think is a product that the market really, really wants, then it makes sense that the IRS has to give specific guidance for these like trusts and the way they hold these assets. I know we'll have to have Greg back on the show because there are some sort of inconveniences that I think were built into the guidance. One of them was that the staking rewards basically need to be, and he'll get on me if I misquote this, but essentially need to be distributed as cash quarterly, which means that they can't necessarily sort of continue to accrue or roll up the benefits of staking rewards. But that's
Hmm.
also not really the point of an ETF. So um, interesting to see that come out, and we'll see how it goes.
Yeah, yeah, for sure. I'm sure. Maybe Greg's watching. He was watching last
Yeah,
week. So if
I'm
you're
sure.
watching, Greg, yeah,
Yeah,
we'll
yeah,
we'll get you back on to talk about it.
yeah.
Well, rolling swiftly on, pro crypto lawyer John Deaton, who lost to Senator Elizabeth Warren in 2024, announced he's running again and the junior senator from Massachusetts, Ed Markey. So he announced that on Monday. I think if you've been paying attention to his Twitter account activity over the past couple weeks to months, you probably knew this was coming. But basically, he's of the opinion that this time around, the Senate race will be probably a little bit easier than going against Warren, who is obviously Warren,
Yeah.
sort of taking a shot at the king. Ed Markey might be a little bit of an easier target, but we'll see. I mean, Markey is very anti-crypto. If I went on Stand with Crypto's politician score on their website, which has been very helpful for my
Good
reporting,
shout out.
especially
Yeah.
during the campaign donation season, when we were reporting all around that stuff. And yeah, Markey has a solid F. He voted against the Genius Act. He's had a lot of sort of anti-crypto initiatives, voting against stuff in Congress. So he's got that going for him. But can John win over the hearts and minds of Massachusetts voters who are, at the end of the day, largely Democrat? John's running as a moderate Republican. It didn't work against Warren. Warren is, as she's an entrenched, an incumbent in that state. So, we'll have to see. But it's an interesting, he's doing it again. He only did it, a year ago. So it's a lot to take on. It'll be an interesting
Yeah.
race to watch.
Yeah, I admire the resilience. I also admire the change of target. I think it's a much more reasonable race. I think we will see, and I was on CoinDesk at SmartCon talking a bit about this. Like, how much will crypto be back on the ballot in 2026? I think there are a lot
Mhm.
of politicians on both sides who maybe want to see it or don't want to see it. Whether they want to be able to continue to campaign on getting market structure passed, so they're actually fine with it, like taking a little longer, and them having a little more financial support, or they're very vocal about coming out against it. And like the anti-crypto voter, I don't think is a super strong voter. But we'll see. Yeah, it's going to be interesting.
Yeah, and we'll be interesting to see if Fair Shake comes up in support of him this time, because they
Yeah.
did not last time. So we also have other crypto super PACs that are materializing seemingly, every couple months now. So if it's
Yeah.
not Fair Shake, it might be someone else. So yeah, with that, let's get to our last story and into our first guest. And the story is Coinbase announcing it's leaving Delaware to reincorporate in Texas, citing the state's more favorable business laws. And I think that is a perfect segue into welcoming Chief Legal Officer of Coinbase, Paul Grewal, onto the show. Paul, welcome to Crypto in America Live. We've had you on the podcast, albeit briefly, and we've always said we want to get Paul back on the show. And so we're really thrilled that you're joining us here today.
Thrilled to be here with you guys. Good morning.
Yeah, good to see you.
Good morning. So tell us about this move, Paul. I know that you guys were incorporated in Delaware. It's kind of become a thing. I hear it's called Dexit. is what corporations are actually calling it, because you're not the first to do it. Elon Musk did it with Tesla and with SpaceX. So tell us your thinking around the move from Delaware down to the South.
We made the decision to move from Delaware and reincorporate in Texas after, not surprisingly, a lot of thought, a lot of care. Having put that thought and care into the decision, we're feeling very good about it. Look, this was as much for Coinbase about making sure that the interests of our customers, our shareholders, our employees, and others that we serve were best served by whatever state we might choose. And after a lot of experience in Delaware as both a private and public company, and after surveying sort of where Delaware corporate law was headed, it became clear for Coinbase that the right answer was to reincorporate in Texas, and we could not be more thrilled.
So, Paul, yeah, it's good to see you again. I know we were briefly talking about this in Philly. One of the things that strikes me about Delaware that it does have is, a century of sort of good precedent in the chancery courts, but the legislature and all the policymakers in Texas seem to be very enthusiastic about creating a positive business environment for boards, for shareholders. And then there's obviously the tax environment. Can you talk a little bit about your conversations when you were, as much as you can talk about them, when you guys were considering the move, like where you saw that enthusiasm and what it was like to try to talk to Texas about this relocation?
Well, I think it's clear to anyone paying attention that not only Texas, but a number of states have really attempted to compete with Delaware for the mantle of leadership when it comes to corporate law, not only as it applies to crypto companies like Coinbase, but to corporations more generally. And I think it's important to understand that while, a generation of lawyers and others like me have been taught and trained that Delaware is just where you go when you incorporate, or certainly when you look to evolve as a company into a more mature public firm, that was not always the case.
Right.
For many decades, it was New Jersey that was the king, and before New Jersey, it was New York. And so, this competition is not something new among the states. But I think it is important that in 2025, each of the states, including Texas, have an opportunity to compete for business on the basis of providing predictability, clarity, certainty, and maybe most importantly, consistency in the way those laws are applied from one company to the next.
Mm-hmm. I didn't realize New Jersey was the place before Delaware. I was going to ask you, yeah, that's my state. I was going to ask you, do you see this mass exit from Delaware maybe making them sort of wake up and think, oh, we should maybe become a little bit more favorable to our businesses and maybe change some things around? But it sounds like the migration maybe happens from state to state, maybe every few years or so. And Texas might be the place now, as well as Nebraska. I hear Nebraska is also a bit of a hotbed.
Right.
I think Andreessen just moved there too.
Well, they moved to Nevada. And
Nevada. I'm sorry.
Yeah,
okay.
Nevada has certainly stepped up.
Very different.
Yeah.
Well, very similar in the sense that, I think they now understand that there's an opportunity to compete for companies, both private and public. And the way to compete is through providing, as I said, the clarity and consistency in the law. It's also through providing courts to resolve disputes that are steeped in the corporate law, that respect things like the business judgment rule, which defer to the wisdom of corporate boards, absent evidence to the contrary. There's a much more, I think, healthy dynamic when different states have a chance to compete for the mantle that Delaware has largely had a monopoly on now for many decades.
Yeah. So, Paul, I'm curious about this. I'm not barred in Texas, so a little unfamiliar with their state case law or sort of that history. Obviously, Delaware, long history of sort of corporate law, corporations. I imagine Texas, a lot of their body of case law has to have like almost look like Wyoming in terms of like mineral rights and natural gas disputes, oil fields, things like that. Do you think that the bench in Texas is sort of equipped to deal with like some of these more novel legal issues or some of these sort of like new technologies? Like how do you see that going?
Well, I do think that Texas courts are more than up to the challenge. And the reason is that Texas has moved to develop specific business courts all across the state that will allow individual judges serving on those courts to just get the reps, as it were, in understanding the nuances of things like the business judgment rule, shareholder derivative actions, and other types of litigation that often befall companies from time to time. And, as a former judge, I certainly can appreciate that you're better on your 5th or 10th case than you were on your first in terms of orienting to a lot of new complex doctrine, vocabulary, and nuance in these types of suits. So it may take a bit of time for individual judges in Texas to get up to speed on these issues, just as it would in any state. But I think they're more than up to the challenge.
Paul, we got to get your take on SEC Chair Paul Atkins' speech this week, because I know you guys were both there. I know you chatted at the event. I wish I had gone down to Philly for it. I didn't realize it would be quite such a crypto heavy event that it was. But I mean, let's talk about the contrast, right, between what this SEC chairman spoke about and what the prior SEC chair, spoke about in his, few crypto speeches that he gave, but just sort of the indications that he gave about how all digital assets were securities, right? And the way that Atkins is treating the Howey test as, sort of this like flexible, like we can use the Howey test, of course we'll use it, but we're going to kind of make it, we're going to cater it to this evolving world of crypto and blockchain. And we're going to, I think I loved your tweet, Paul, promises may not remain forever, and neither should status as an investment contract when that happens. Can you just talk about, the change? It's been 9 months since Atkins has been in office. It's wild, isn't it?
It's been 9 months, but in a lot of ways, it feels like 9 centuries. The contrast between the prior regime and the current leadership could not be more stark. Look, I think what we heard from Chairman Atkins in Philadelphia was a confirmation that the SEC is returning to its original place and assuming its original responsibility for bringing certainty to the federal securities laws as opposed to creating chaos. I think what I heard in Chairman Atkins' speech that was most striking was that he was not simply throwing out decades of precedent and decades of history in announcing a new framework or a new standard, but rather grounding what I think is a sensible way to think about how investment contract law applies to digital assets in that same precedent, in that same history. Whether it's in confirming that investment contracts may start out as federal securities, but could and often do transform over time, or whether it's in confirming that the subject of an investment contract is not in and of itself an investment contract. This is just, I think, good old-fashioned federal securities law 101. And coming, from the chairman of the SEC himself, it's just it's reassuring to many of us in the industry that we have someone in leadership at the commission who really appreciates history, but understands the need to evolve that as new markets and new technologies emerge.
Paul, I'm curious. Obviously, we're going to talk to Cody a little bit later on in the show about the Senate Ag draft that came out. A lot of brackets in that document. But just on the subject of the other comment that Chair Atkins made about making sure that we do get legislation that codifies this, and we're not just relying on rulemaking and like the whims of agencies. Do you see a lot of that sentiment hopefully ending up in the eventual draft of market structure that gets out there, or what do you think about just that comment that we need to make sure we get this into legislation?
Well, there's no question that the chairman of the SEC, for good or for bad, has an outsized voice in any conversation about the future direction of the federal securities laws. And I'm hopeful that Chairman Atkins this week in Philadelphia will be no exception to that. What I thought, though, was most striking was that he made it very clear, at least to me, and I think to anyone paying careful attention to his remarks, that he, along with Commissioner Peirce and others working at the SEC on these issues, are looking to ground this framework, this evolving framework, in not only precedent, but in the legislation that is to come. And so there won't be the sudden shifts and jerks left and right that many of us have suffered for many years under the previous regime. You're going to see consistency and a continuity that I think will benefit us all. And that's really what I took away from the chairman's remarks as much as anything else.
Mm-hmm. And then what's your take on the Senate Ag draft that we saw on Monday?
Well, there is more work to be done. There were a lot of brackets, to be sure. But
Yeah.
I think it's important for all of us to just take a step back and appreciate that, not many months ago, it would have been complete fantasy to imagine that we'd see Democrats and Republicans working together on serious draft legislation. You'd see Democrats and Republicans each picking up the pen to offer their own views on all the issues that need to be worked out in terms of token taxonomy, spot market authority for the CFTC, all the issues many of us have been working on now for a long, long time. So while there is a lot of work that lies ahead, I think we're getting close. I'm very much in the camp of we're going to get this done. I know some people fret over the details that remain to be resolved. They see a lot of blank text and they wonder how on earth could we get to a place where there's actual legislation being debated on the floor, enacted into law, signed by the president and all of that. But I think we're going to get it done. It's just we have to continue to work hard on this, even if it feels like there are still some important obstacles that remain.
Yeah,
Mhm.
definitely a lot of work to be done. Also, hopefully the work picks back up, right? We're talking the week of the government shutdown ending. How quickly do you think we're going to get sort of folks back on the Hill having these conversations, whether it's the industry with policymakers or policymakers with each other, or regulators with policymakers? Like, how quickly do you think we kind of ramp back up into full steam ahead here, knowing that we're going into the end of the year as well?
Well, even during the shutdown, I think we made good, solid, steady progress on a
Yeah.
number of issues. And so now with the shutdown coming to an end, I think we're actually going to see the machine, as it were, kick into high gear immediately. And I say that because it's clear that with Democrats and Republicans agreeing on very little right now in Washington, they actually all or mostly seem to agree that we need to move forward with this bill. And so I think while it will take a bit of time, maybe a bit longer than some of us would like, for staff and others to re-engage fully. I think they're more than up to that task, and we're going to see it happen right away.
Mhm. Well, Paul, thank you so much for coming on. We love your takes, and we'll have to get you back on soon.
Always good to see
Yeah,
you
thanks,
guys.
Paul.
Thanks for having me.
Appreciate it.
Thank you. All right. Well, joining us now, we have some big news, right? This XRP ETF has kind of
We have some
gone
news. Yeah.
gone parabolic, as they say. It's Thursday debut on the NASDAQ. I mean, Canary Capital's XRPC, the first pure play XRP spot ETF on Wall Street. And I say that because there is sort of a difference between, and we can kind of get into this with Steve, but basically it's the only spot ETF that has all XRP in it, not sort of a mix of XRP with sort of other things in there. Posted the biggest launch of the year with the largest day one trading volume for any ETF in 2025 at 59 million. It narrowly surpassed Bitwise's 57 million debut for its BSOL ETF last month, which had the top spot among 900 ETFs that launched so far this year. So let's bring in Canary Capital CEO Steve McClurg. Welcome, Steve.
Hey, Ellie. Hey, Gerald. How you doing?
Good.
Fantastic.
Happy
How are
Friday.
you?
Happy Friday.
How's your Friday? How's the ETF doing today? I know yesterday was a bit of a whirlwind for you, I'm sure.
I don't know. I just woke up. No, just kidding. Yesterday we were out pretty late. It was processing that kind of volume takes a pretty Herculean effort. We were expecting it, but we didn't expect it the way it did. Especially on a down market day. It seemed like we had a lot of forces running against us, but it still worked out.
Yeah. Can you explain? So I did see that you were on with Nate Garachi, and there was some comments about, okay, so there was 59 million in volume trading, right? And then there was almost $250 million in inflows. Can you explain sort of the how that squares? Because I think there was okay, that seems like a low trading volume for that amount of inflows, but it had to do with the in-kind settlements, I believe. Can you kind of explain and walk us through how that worked?
Yeah, absolutely. So, when Bitcoin and ETH ETFs launched, in kind wasn't allowed. So you didn't see a lot of that in those two products. Same thing with any type of futures related products. You're not going to see a lot of in kind because it's futures. But in kind in crypto ETFs is a very new thing. It's really it's really only coming about this summer. And since Canary has launched its first ETFs. We've launched with in kind with both Litecoin, HBAR, and now XRP. As a matter of fact, HBAR received a lot of in kind as well, as did XRP. And from talking to people, there's a lot of people out there that simply just want to move their coin onto an ETF for ease. I mean, I'm personally one of those people. I would have done that with the Bitcoin ETF had we had the opportunity, but I've slowly shifted a lot of my own Bitcoin out of my own wallet into ETFs just because it's easier. But when you are affecting those types of trades, it doesn't show up in volume because you're not going online and trading that ETF. You're simply going to your broker and saying, okay, I want to trade in this amount for these shares, and then they occur. Now, in-kind trades also happen through APs. And the way that works is, APs are really there to help arbitrage, an ETF. And this is really what makes an ETF unique to a lot of other products is they're making markets. And when orders are coming in, they're sometimes putting forward or pulling back. And at the end of the day, they're reconciling their own book and they're either creating or redeeming ETFs based on what the volume looks like. So if there's more buyers than sellers, you're going to create. If there's more sellers than buyers, then they're collecting everything and putting them through. But by the way, if you look at BSOL, you'll see that even that was higher inflows than volume because you did get a lot of in-kind transactions there as well.
Yeah, that makes a lot of sense. Steve, I'm curious. When I first met you a while back, I know you guys have just been really, really like get there first, launch things into the market. And so you guys have had a lot of filings. You guys have had a say ETF out there filing. And I'm curious, I hate to keep harping on the shutdown, but it is just a really interesting time, if you've been paying attention to what's going on with our industry in DC. You guys had some filings out there, government shutdown. Did that impact the speed with which you guys could get to market, or how does that impact what you're doing?
Yeah, with XRP, it did impact how we were able to come to market. It's sort of like, are you willing to take a risk? And the risk is extremely low, given the guidance that we got from the staff when the government shut down, and then of course the subsequent communications publicly by the new chairman. But we're like, well, why not? Let's file for XRP as well and see what happens. And sure enough, we got out there. We filed originally really early for Litecoin and HBAR, and somebody told me, and I don't know if this is true or not, but it was something like the first time an ETF is filed with no delay in that manner for a 33 Act in 20 years. So we were the first ones to do that when the government shut down, but we were also right at the finish line on Litecoin and HBAR. So we felt like it was a good opportunity, a good signal to go ahead and move forward with those, and then subsequently with both XRP and Solana.
Was there ever any anticipation that maybe with the government opening yesterday that the SEC may step in and say, oh no, we're not going to green light this? Were you ever worried about that? Because I know that there was I know that there was some with the Solana ETFs, the SEC had provided quite a bit more back and forth with the comments than they had on the XRP ETFs. So there was some question over whether maybe the SEC didn't think the XRP ETFs were quite ready to go in the same way that the Solana ones were. So I'm sure you just said there was some reservations, like, oh, maybe they'll step in, but they didn't.
Yeah. Well, we actually felt the opposite. We felt that there was more risk filing for Solana than XRP, even though technically there may have been one more comment period with Solana than XRP, but most of the comments for Solana were around staking. And that is something that is a really new feature for crypto ETFs. It's new for ETFs, period. We were just on a call this morning with our fund admin discussing, okay, how are we going to record this? And I used to run bond ETFs. So I was like, okay, well, how did you do it when we ran bond ETFs back in the day? And they're like, well, those are easy because there's a coupon and we know exactly what it's going to be. And I was like, well, I used to run bond ETFs for asset-backed securities that had floating rate coupons, right? Floating to LIBOR or some other reference rate. So how did you record those? They kind of scratched their head a little bit like, oh yeah, we'll do it the same way. Well, there you go. Because what happens is you accrue that income from coupons on a daily basis, and then you report it and you drop it in. And we're really doing the same thing for staking. So, but there is a lot more mechanics to play in staking. We've filed several staking ETFs, including SAY, and those are probably the biggest issues that we're working through. Is like, okay, how do we functionally do this from an operational standpoint? How do we do it from a legal standpoint? How do we do it from a tax standpoint? Tax within grantor trust is a really big deal, and we can, get nerdy and go into that if you want. But the other thing is each token stakes in a very different way that has staking features. Some has slashing, some don't. Some have a longer lockup period, and each one of those factors has to be really considered. And we've got to write out risk disclosures for all of that. So there's a whole other world behind it from a legal, from a tax, from an operational perspective that we have to work out before we move forward. So from that perspective, we felt like XRP was basically done, and Solana was the one that we were still working out the staking thing. So we were kind of reversed in our decision there.
Yeah, I'm curious. So I know we have a friend in common in Greg, and obviously we were talking a bit at the beginning of the show about that IRS guidance that came out. This is kind of a two-part question because I feel like every week we're talking about GLS at this point. So our viewers are going to be generic listing standards experts here in the near future. How helpful was that IRS guidance in dealing with some of these issues, or do you think there's still a lot to be kind of fine-tuned there? And then two is just in terms of getting those assets out. Do you have any insights on where you think we are in terms of updating or broadening GLS for more assets?
Yeah, absolutely. Well, first of all, I do, you called out Greg, so I'm going to call him out too. Greg is an amazing legal mind in the crypto space, has been doing it forever. And I'll point out that we actually worked together about probably 4 or 5 years ago to launch the very first private grantor trust that had staking. And so we solved that from a structural, from a legal, from a tax perspective 4 years ago. So this wasn't too hard for Solana. It hasn't been too hard for say an injective either. It's a little bit more difficult for some of the other ones. But when that tax guidance came out last week, we actually considered pausing our Solana roadmap a little bit until we really got through that. But after we studied it, what we realized that it really probably has more to do with the safe harbor provision for existing grantor trusts that are switching over to staking, such as some of the Ethereum products that are out there. And I think it's great that that Scott Bessent worked with the IRS to come up with this guidance, because otherwise there really was no safe harbor in a grantor trust structure. Once you create the structure, you have to stick with that structure almost through the end of time, and it's very difficult to change it. So we believe that it applied more to that. And then when we were looking at, for instance, Solana, and I say that because it's top of mind, because we just had an ETF that's come out through a couple of issuers, and then a few are more likely coming next week. When we compared those issues, we really didn't feel like we even needed the safe harbor for Solana. So I think the other issuers are fine. And we decided that, we're not going to pause on ours either.
Yeah, I just want to point out, because Gerald mentioned the shutdown earlier, there were 900 applications that were filed during the shutdown, and the SEC had to put out guidance today on just to kind of tell the industry like how they're working through that, and just to say, hey, we are working through that, and here's how we're going to do it. So it'll be really interesting to see kind of the flow of how sort of the backlog and how they deal with that in the next couple of weeks.
Oh, absolutely. Well, and just to, be transparent, we still have one ETF left that has been filed with a no delaying amendment. The rest that we have on file, we are planning on continuing to work through comments from the staff before we do anything with that. We had one that we considered going ahead and filing, and then when it looked like the government was going to open, we're like, look, we're not going to, we're going to go through the process, as cleanly as possible here. We're not going to try to, push anything forward that doesn't need to be pushed forward too early.
Yeah, Steve, I'm curious. Obviously, a lot of ETFs trying to get to market, a lot of different assets looking for that sort of TradFi wrapper exposure. You mentioned when you came on, there's this really interesting thing happening right now where the debuts are going really well while the overall sort of crypto market is kind of, let's just say, sliding in lockstep with the NASDAQ. Like that's, maybe the easiest way to say it. Why do you think there's such a, maybe not a bifurcation, but there's so much momentum for some of these ETFs when sort of the broader market is maybe struggling a little bit?
Well, I think it goes back to the broader economy and what's happening there. There was actually a very good, I reposted it on Twitter this week, and I think everybody should give it a listen. My old colleague and good friend Ann Walsh gave this really amazing, succinct commentary on what's happening in the market, the bifurcation of the two different economies right now, and what that would likely lead to as far as rate cuts in December. But at the end of the day, we've been seeing that all year long, where the retail audience is really struggling a little bit more right now, just because from even from a past inflation standpoint, there's a lot of people that can't afford basic things like food, mortgages, auto payments, student loan payments, things like that. And if you look at some of the data, you're seeing that delinquencies across the board are as high as they were since 2008, whether it's student loans, autos, credit card, mortgages. But the institutional market is still flush with cash right now. So what's happening, and this is just our observation here, is that as these tokens are moving into an ETF or the ability to invest in through an ETF, you are getting more institutional investors and or families that are, call it top 10% of wealth, are able to invest in them more easily. So you're seeing the inflows coming in through the ETFs, but you're seeing the retail market doing more selling across exchanges. So right now that selling on the retail side is a little bit higher than the investment on the institutional side, which is one of the things that are driving prices down across the board. But that's really what I'm seeing and I'm thinking. So, like yesterday we had, such a lot of volume, not only in the XRP product, but also in HBAR and Litecoin. We had new inflows as well on a down day. So we are seeing that institutional money moving in.
So what's next, Steve, after XRP, Litecoin, and HBAR? What are you hoping to bring to market next?
Yeah, I mean, look, you can probably guess by some of the filings that are out there of what the actual next thing is. But the thing that I'm actually very excited about is getting these various stake tokens in an ETF format. And not to name the one that's imminent, but look, also we have SWE, we've got Say, we've got Injective. Those are very exciting to me. Very, very exciting projects. They're great people. They're all doing very different things that I think the world needs to see and know about and have the ability to allocate to.
Yeah, absolutely, Steve. I'm curious just on that topic, because staking reminds me of some of the conversations around getting validator exposure, DeFi exposure to public markets through some of the DATs that we saw launch over the summer and into the fall. And we had the CEO of Bitwise on last week, and he made a really interesting point. I kind of nerd out about this idea of MNAV, and just the fluctuations there and like what it does to price action, and like there's M&A strategies that can be built around it now. ETFs, as he made the point, are basically one-to-one NAV, ideally, right? What I'm curious about is, how does staking factor into how an investor should be like pricing an ETF versus something like a DAT running a validator? Does that make sense?
Oh, absolutely. So look, I think staking is something, it's hard for me not to think about it through the lens of a fixed income, but I love fixed income because you're not only are you top of the stack as far as if something goes wrong with the company, you're the first one to get paid, but you're also receiving a set yield on the debt that you're lending. And even though it's not an exact one-to-one when it comes to stake tokens, you are receiving an income for being a part of the system itself, right? So it's almost like everybody becomes a personal bank in a way, right? So like imagine if you you were a member of a bank. Well, credit unions are sort of like this, right? Where you're a member of the credit union and you get a yield based on how much money the actual bank made. But in large commercial banks, you don't get that, or large consumer banks, you don't get that. Like, if my deposits at Chase, they charge me for wire fees, they charge me for all kinds of fees that you don't even know about, and I'm not getting a fair income on the holdings that I have there, nor am I receiving even a dividend for just being a customer. The world of blockchain, when you own a protocol and you actually participate in the network, you get rewarded. It's almost like you're getting that wire fee back a little bit. And it really is a thing of beauty where you get to participate in the network itself. So the more the network grows, the more transactions there are, the more you get rewarded for being a member. So yeah, very, very, very similar to a community bank or a credit union is probably a better way to describe it. But having that participation and then rewarding the holders of the ETF for that participation really is a new concept that I'm extremely excited about, and I think it'll really open up the eyes of a lot of people on how protocols actually work.
Awesome. Stephen, thank you so much for joining Crypto in America Live today. It's been a pleasure. We'll have you back soon.
Thank you.
Thanks, Stephen. Good to see you.
Good to see you.
All right. Well, our last guest today is Cody Carbone from the Digital Chamber, who we're bringing on to talk about the Senate Ag draft, which dropped on Monday. And the industry was quick to kind of come on board and say, hey, yes, we are so glad this is here and we're so glad it's dropped. It's been so long. And we want to get Cody's take on what they're really saying behind the scenes, what the industry really thinks about this bill.
The brackets.
The brackets, yes. This bill was full of brackets, as I think we knew it would be. Brackets for those that don't know basically means it's areas of the text where lawmakers have not agreed on yet. So there's still obviously a lot of work to do on this bill, and I'm sure Cody would agree on that. But here he is, Cody Carbone from the Digital Chamber. Welcome to
Looking
Crypto in
sharp.
America Live.
Looking sharp.
What's going on, friends? Thanks. I had to dress up just for you guys, of
I
course.
appreciate it. Yeah.
It's good to see you
Love
guys.
it. You too. So yeah, give us your take on what dropped on Monday. I know you put out a statement, but give us the take beyond the statement.
Well, as Gerald said, brackets. It's all brackets. So it is an unfinished product, but glad to see the progress. This is something we've been waiting for months now. I mean, we passed the Clarity Act out of the House early in the summer. We had the Senate banking discussion draft, and the missing piece of all of this in getting market structure across the finish line was the Senate Ag Committee draft. And so finally, after delays, we had an initial deadline of Halloween, we'd see a draft. Then it came out just this past Monday. It's great to see the progress. It's great to see some of the provisions in the draft, what they're thinking in the discussion draft, that we saw the preservation of the Blockchain Regulatory Certainty Act. We saw increased self-custody protections from the Clarity Act. But it's unfinished. A lot of those brackets on arguably the most important pieces of the draft. How are you going to regulate DeFi? How are you going to regulate in terms of an AML, BSA compliance regime? So unfinished, but good progress nonetheless.
Yeah. So Cody, I'm fond of saying this is actually a 190-page bill that's 155 pages right now. I think that's probably about the amount of text we're missing.
Yeah.
So walk us through, like, what's the next step here? How do we fill that in? I mean, are we waiting on Senate banking? What are the next steps to kind of figure out what should be going in all those empty spaces for right now?
I think in a perfect world, we would see the Senate start to follow the process that the House has done from the very beginning. The two committees need to talk to each other. Right now, it's being done in somewhat of a siloed format. this bill only works if these committees get together and they make one product. And so I would love to see the Senate ag drafters start to sit down with the Senate banking drafters, both the Republicans and the Democrats. It's easy to forget that on the Senate banking side, the draft that we have, the RFIA, is a Republican only draft still. We need to see one bill. We need to see bipartisan buy-in from this. So yes, these two bracketed portions where we don't have answers, that's the next step, Gerald. They're going to have to fill those out. It's easy to kick the can down the road and just say, hey, here's something. We're still working on the very hard pieces. I appreciate the transparency that they wanted to at least give something for industry to respond to while saying, hey, we're starting to work on the very, very difficult parts. They have to figure that out. The best way to figure that out is if all of the four corners of this bill start to work together. Get the chairman of Senate Banking, the ranking member of Senate Banking, chairman of Senate Ag, Cory Booker, who's not the ranking member of Senate Ag, but is leading these discussions for Democrats. Get them all in a room and have them do this together. That would be the best and most logical next step. Whether that happens, TBD. That seems like it's too much common sense for Washington and Congress. So what I think more practically happens next is Senate Ag continues to take industry feedback, and over the next few weeks, they start to fill out those bracketed portions.
Do you get the sense that perhaps because the BRCA and sort of some of those more like DeFi native portions of the bill fall under Senate banking's jurisdiction, that perhaps Senate banking might be doing some more of the heavy lifting on the DeFi side, and then once the bills kind of merge together, they might be one cohesive bill as opposed to Senate Ag working on DeFi and Senate banking working on DeFi and then kind of working, like putting them all together? Do you get the sense that maybe like Senate banking is doing that and then Senate Ag is kind of waiting on them? Or do you get the sense that like they're both going to do it and then come together and have the conversation? Because frankly, and Gerald mentioned this as well earlier in the show, like time is ticking down. We're already almost at Thanksgiving. Like, this bill is obviously not going to get passed this year, but it's got to get passed before the midterms, right?
Yeah, 100%. I think what will happen is that both committees will likely try to tackle this issue, and then they'll try to come together and find a compromise. I think the logical thing is for Senate banking, because it falls under banking jurisdiction. Most of the issues in this bill as it relates to DeFi and it relates to the BRCA and the BSA AML regime should come from Senate banking. And so we need to see the result of those negotiations between the Republicans and Democrats on those main issues. This is the first time I've ever seen in a legislative draft, in the Senate Ag draft, where there was a note that say, hey, the minority staff, Senate Ag Democrats, don't agree with including the BRCA in this draft because we don't think we have jurisdiction. I've never seen that before, but they're probably right. It probably needs to come from banking. And it's why the House product was so much easier, because both committees were working from the start, from the very beginning. And so while there was jurisdictional issues, they were able to have those conversations at the table and even draft the text together, but the text would come out under that specific committee of jurisdiction. So I think Senate banking needs to take the lead. I think Senate Ag wants to see where they can be helpful, and we will likely see draft proposals from Senate Ag as it relates to some of these provisions. They're going to have to get together either way, though. So we'll see what happens. I've never seen that before from the Booker staff and the Senate Ag minority, but they're probably accurate.
Yeah, Cody, I'm curious. We talked about, I think maybe last week, and I've talked to a lot of folks just candidly about when the shutdown was going to end. And I think it was the consensus was same as 1819. You ground the flights, people come back. Like it's just what happens. And so in terms of next steps for this legislation, obviously, Ellie mentioned midterms coming up. People want to campaign around this issue, whether for or against, right? Whether it's progress they've made or work they still have to do and would like to do. So that seems to me like kind of the opposite end of the bookend here of like what drives things, action here. What do you think is maybe the DC is a very very busy, very kind of distracted place right now, right? Like there's a lot going on. So what do you think actually kicks legislators into gear on the next steps here? Is it something maybe from the administration, a push? Is it maybe something from industry? Like where do you see that energy coming from?
I think it's going to have to be industry. You kind of alluded to it, Gerald. Politics drives policy in Washington. And this industry is not shy to get involved in politics, as we saw from the 2024 election. And they've already been very loud about how they're going to get involved in the 2026 election. The industry is demanding a market structure bill. They don't want it tomorrow. They wanted it yesterday. And we share that. We need this for regulatory clarity, for the US to be the crypto capital of the world. So I think lawmakers are very self-aware, and they know that the industry is demanding this bill, and they will be so influential in the next election. I think that is already a motivating factor that's been there for the last 10 months of this Congress, but will continue to be there. I think that's why we are seeing such ambitious deadlines, and why, if you look at the Senate Banking's legislative calendar this year, the two issues they prioritize the most are stablecoins, passed, great, and then market structure. It's no secret that the prioritization of their calendars has been on crypto-related legislation. So I think that will always be there, and that will continue to motivate them until we get to a point where legislators just aren't here in DC anymore, that it becomes full-on campaign season. And maybe that is still something that they try to do while they're out campaigning. Hey, can we get a market structure bill? There is a political reason for both Democrats and Republicans to want this. You mentioned the administration. They're always going to play a part here. And at what point does the president or David Sachs or the Treasury Secretary start to say, hey, we need a market structure bill now. Let's push it. When do we start to see those Truth Social posts? I would imagine we're not that far away from them. So I think politics will always motivate them to get this done quickly, but we're running out of time. Not only in the calendar year, we're running out of time this Congress. It's crazy to say, but a lot of legislating has already happened for this Congress. So TBD on whether we can get it done, but it's going to be tough.
Cody, how big of a problem do you think the ethics clauses or provisions are going
Conflicts
to be?
of interest, yeah.
Especially, conflicts of interest. I mean,
Yeah.
we saw the CZ pardon and how much of an uproar that caused, not just with Elizabeth Warren, but with, members of the House, Maxine Waters. I mean, it's been a real point of contention before that, even with the Genius Act passing, and just that seems to be the sticking point with Dems, right? I mean, it's going to come up in the market structure bill. I mean, how much of a problem is that going to be for passage of market structure next year even?
I wish I could say it wouldn't be, but it's going to be huge. It is candidly, it's the largest substantive point of disagreement right now between the parties. We can talk about DeFi and we can talk about getting this right, but there's buy-in from both sides that they feel like they can fix and figure out the market structure issues as it relates to digital assets. Where they are struggling to figure it out is the conflict of interest piece. Who can issue a token? Who can be affiliated with a blockchain project? Is it going to be a prohibition on just the president, the vice president, elected officials, executive branch staff? Possibly. I think everyone can get behind that. But the question is, where do you draw the line into where that prohibition extends to? If it extends to the president's family, you're going to have a real issue. I don't think you're ever going to see the White House get behind that. And if the White House is never going to get behind that, Republicans are not going to get behind that. That's not going to be something that they say, okay, we agree, we'll pass this bill, and then the president's going to tell us later he disagrees. They already know where the administration stands. So how do you figure that out to where the prohibition extends to? The president has no interest in limiting his son's ability to interact or to invest or to work with this industry. That's what Democrats want, because they believe his sons are very influential on his own policy beliefs and how he's going to treat this industry, like the Binance part, and that's what they believe. So it's going to be really tough. Until they can figure that out, we don't have a market structure bill or a path forward. That is going to be the substantive hangup and that will stop us from getting this bill or allow us to move forward.
Yeah, Cody, I'm curious, switching gears a little bit. You mentioned Secretary Besson. He got a whole lot of reading put on his desk about a week and a half ago with the comment letters going to Treasury on Genius and the treatment of yield. That was, I think, something that we also didn't see any major changes, in the Senate Ag draft, which I think maybe people are expecting, whether it's through guidance or through some kind of additional provisions in market structure, that there's going to be some kind of modification to the rules around yield, which obviously, like, Genius is settled law. So we'll see how that goes. I was just wondering, what do you think? I think the chamber submitted a comment letter. You guys are part of one. Yeah. And obviously there's a whole lot from the banking side. How do you see that shaking out? I know at the Philly Fed fintech thing this week, it was like a big topic of conversation just because institutions really want to do stuff and they're trying to figure out how. And so where do you see that going?
I don't think it'll change, to be honest. I think the prohibition and the statutory language that is in the Genius Act, the prohibition on yield, is very clear. It only applies to the issuers. If you look at the statutory text of the Genius Act, Congress uses many times indirectly or directly passing down something. They regulate issuers, they regulate digital asset service providers. They only limited the prohibition to directly impacting issuers. They didn't extend it to digital asset service providers like a Coinbase. So if you're getting your rewards from holding USDC on a Coinbase, that should be allowed under the bill. So to me, this argument that is, oh, this is a loophole. No, this isn't something new. Congress knew this was going on. Coinbase didn't just start doing this after the Genius Act enactment. There should be no reason to change this. The legislative intent is clear. I would expect from talking and working with the OCC that they have no interest in changing this. They just want to follow the statutory text. From talking with Republicans, they have no interest in relitigating this in a market structure draft. The bank lobbies, the American Bankers Association, the Bank Policy Institute, they've done a great job in making this an issue. But they could have made this an issue when we were debating the bill text and passing the Genius Act, and they didn't. They got their prohibition on yield to the issuers. Good job for them. But we
why
shouldn't
was
go
that,
any further.
Cody? Is it they just didn't know about it, or they just didn't care at the time? They thought the issuers was a much bigger deal, and they didn't realize that this sort of the secondary market stuff wasn't gonna come up in this sort of way. Like, what do you chalk this up to? Because I feel like that was a big oversight on their part.
It was. If I can't even guess. I don't want to assume that they didn't know because it was so obvious if they ever interacted with an exchange, but maybe they never have. I think the lawmakers definitely knew because it was raised in talks that this is how people receive rewards right now while they hold stable coins. There's also a massive benefit to merchants and their massive benefit to consumers by having rewards because it allows merchants to potentially lower prices when they're able to get some of the rewards. It allows consumers to have lower prices when they want to buy goods with stable coins. Everyone knew about this. So the fact that they are crying foul after enactment just seems to me like sore losers. But I can't really guess why they didn't advocate harder or why the advocacy is coming after the fact. I can't assume.
Yeah, I want to ask that as like a slightly different way because I know that this has been a big topic for a long time, just in terms of the sort of product market fit of stablecoins, if you will.
Yeah.
I think the industry has known about this for a long time. Do you think that the banks were blindsided by just the potential volume that would be sort of unleashed like after Genius, where finally like people know what to do, right? It's not just like Circle and Tether and Paxos and a handful of others kind of figuring things out. Um, how ready do you think like TradFi, and I know obviously you talk to a lot more of our industry folks than the banking side, but how ready do you think they are for this, like in terms of what's happening with stablecoins?
So I think number one, the pushback overall is just on competition. You laid it out well. It is strictly on competition. I don't think they were surprised by the volume because every single bank was trying to figure out how to issue a stable coin or how they were going to interact with the digital asset space or with distributed ledger technology for years before this. This wasn't something new or novel to them either. I think they are surprised at how mature the current issuers are and how that they were already and where the competition or competitive advantage was. I think they underestimated the digital asset industry to show that a Circle, a Paxos, a Tether was almost on an even playing field with them in terms of distributions and in terms of users. I think that's what they underestimated. I think they saw the market potential from the very get-go, and that's why they were studying this for so long. Now it's how do they pivot? Okay, we don't have the competitive advantage we thought going into this. We thought we already had this massive user base that as soon as we launch a stable coin, we would be in a good place. And that would likely see the need for a USDT or a USDC to go by the wayside. I think right now they're waking up to the fact that that won't happen that those user bases in the near term, before, as we're going through this implementation process, will continue to grow on the digital asset native side. So now they're trying to find their competitive advantage once again. That, I think, scares the hell out of them because they don't know where they're going to go. And that'll be fascinating what the next 18 months looks like as we finish and finalize Genius Act implementation to how they will compete.
Yeah,
Right.
absolutely.
Yeah. Cody, I got to get your take before we let you go. Chairman Bozeman said they've committed to a market structure markup in December, early December. You think he sticks to that timeline?
Oh, if I was, I don't trust any timeline in DC. This has nothing to do with Senator Bozeman and Chair Bozeman
Congress
and
in
his
general.
team.
Yeah.
Congress in general. It's just like, it's so, any timeline in DC, I always just add 2 weeks to a month after. So when you look at December, it's really tough because then you're at the end of the year and you're in holidays. I'm very hopeful and optimistic is the company line. I think we can get it done. And I think we can have that markup. I think what will dictate that markup and what will be really telling and where I'll have more confidence is if Senate banking sticks to their markup before Thanksgiving. That will be really interesting. I know from talking with Chairman Scott of the Senate Banking Committee that Democrats are already trying to postpone that and they want to extend until December as well. If Senate Democrats on the banking side are taking that position, I wouldn't be surprised if Senate Democrats on the agriculture side are taking that position. So if the banking markup goes off without a hitch in November, then I will feel very confident we'll have in early December the ag markup. But if we don't see any of those by Thanksgiving, then I think we'll be in a tough place and we'll be looking to early 2026 for some of the markups.
We'll have to go check Polymarket for the answer. Yeah.
Of
Cody, thank you so much.
course.
see you
Thanks for having
soon.
me, guys.
Yeah. Good to
Of
see you.
course. All righty. Well, that wraps us up for the week. And I just want to give a shout out to, I think, our 11,000 listeners watching live. So if you joined us today and you enjoyed the show, thank you so much. We appreciate you guys. And we will see you same time, same place next Friday. Gerald, have a good weekend.
You too. Thanks,
All
everybody.
right. Bye.